Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes here on Options Guide TV. I think we'll do a little bit longer show today. We usually average between 20 and 30 minutes for each session of Options Guide TV. And we're going to start off. Today, I'm going to hang out mainly in the paper trading portfolio of deep in the money call options. We kind of hinted to it on Monday's show that there are some adjustments that we need to be made. In general, the portfolio is doing very well. I can actually say extremely well, but it's not always the case. Past performance isn't always a guarantee of future results, but a lot of it has to do with NVIDIA. That stock has really driven that portfolio. But today, we're not going to focus on that underlying. We're going to look at a couple of the other underlyings that have done well. Specifically, we have not rolled or adjusted our Google position, or otherwise known as Alphabet. And then also our Charles Schwab position has done fairly well too. Well, it's done well, but compared to the rest of the stocks in the portfolio, it's only done fairly well, I guess would be the best way to say that. So we did a rinse and repeat strategy on our S&P 500 index trade. Okay, so on Friday's Options Guide TV, the forecast was basically that we didn't see much volatility in the marketplace, that the marketplace was going to kind of stay in check. So we did a 1 day, actually a half a day butterfly in the SPX. And that trade worked out very well. It was 15 points wide. We put it on for about 4.5. There were opportunities to sell. Obviously, we weren't taping the show all day long, but there were opportunities to sell that butterfly for somewhere close to 12, which is almost the maximum on the trade. If you rode it all the way to expiration, the cash settle feature of the S&P 500 index would have happened, and you would have actually came very close to clearing out for around $8, meaning you paid let's call it $4. You sold it for $8, made around $4. Now, it was as close to a home run as you could get, considering that you could almost sell it for $12 at some point in time. Depends on the bid-ask spread and trying to get a midpoint fill, which is a little bit harder to do as expiration approaches and the bid-asks get wider. But most of the time in the SPX, you can get a solid midpoint fill. So we came back on Monday and we said, all right, we've been looking at 1 week butterflies. We've done a couple of skip strike butterflies. Let's do a rinse and repeat of the standard butterfly, but we're going to come back and only do a 2-day trade. So the trade that I put on, and I can't show you inside the paper trading portfolio, so we are not going to go to the Tradier Pro to start with. And I have a screenshot that I want that just basically tells me where the trade is at. I tweeted out yesterday that I would have closed it on very close to the close yesterday. But when we put the trade on, the market was trading at 54. I'm sorry. When we put it on, it was 54.82. 54.82 in the SPX. 54.82. We bought the 54.65. So we went a little bit in the money in that instance on the call side. Then we bought the most at the money, or we sold the most at the money, which is the 54.85. Remember, the market was at 54.82. And then we went 20 points higher and we bought our last wing of our butterfly, our true protection, which is 55.05. We did that for $3.50. Now it's 20 points wide, a little wider, but the fact that we went out and had 2 days to expiration meant that we could actually get this done for cheaper. So cheaper is always better when it comes to butterflies. That means that your max risk is lower. So every 1 by 2 by 1 butterfly, we had a max risk of the net debit of $3.50 or $350. Our max upside would have been if it goes out right at the middle strike, which is almost impossible to do. But that max upside is 20 points, the width of the spread, minus the net debit paid, or $3.50 or $16.50. So a little bit higher max upside. mainly because, first of all, we didn't pay as much and we went wider on the butterfly than we did on the Friday trade. Okay, so now yesterday, and this just shows you the power. This butterfly to me really shows you the power of time decay. And especially when you're dealing with very expensive options on very large valued indexes like the S&P 500 index. And NDX is a real good example of it. NDX is a little bit more volatile than the SPX, but it is a good example of a very high valued index. So with this said, um, the market actually went down and came back up in that short little time frame. And as of yesterday, at the close, very close to the close, it was the SPX was at 54.69. So our at the money option contract was 54.85. The market fluctuated and came down, and yesterday was trading at 54.69, which is obviously going away from the strike, from the middle strike where we want it to be. But the actual trade, because of time decay, mainly, the VIX stayed pretty much where it was at, right around 13. So the volatility was pretty stable. And we saw that we could close that trade out at the midpoint on the close yesterday for $5.90. And considering that was almost a double, like $7 would have been a double, right? I don't want to take the overnight risk of the market. And so I would have closed it. And I tweeted that out that that would have been the scenario. You would have flipped the script. And instead of paying $5.90, right, you would have sold to close the position for $5.90. And then if we look at it today, so if you did not close it out yesterday and you look at today's position, the market is now at 54. It's basically done nothing. 54.67 right now using a live quote. And we see that this is now trading at $4.65. So we went down a little bit, 54.69 to 54.67, in the wrong direction though. We went down towards our strike price, and we've lost about $1 on the trade today. So we need the market. It's going to be this last leg of the trade, the last period from here on out, we would really need the market to start going back up in order for this to really be profitable. And who knows? I mean, this is a an inflection point. If you put the butterfly on Monday and you fell asleep, you need to do something before the close today, and you would want to trade out of it. I would have done it yesterday because I would want the market risk for today. And if you do, there's, if the market is open, let's say we did two of these butterflies, um, and the market was open. Well, I might have sold one yesterday and let one ride today. So that would be a different approach to it. And I've done that a lot in my own portfolio. We always usually talk about a one lot here or one unit. It's which would be a better example of when you're talking about a butterfly that has three legs. So one unit trade, and but if I had just one on, I don't want to take the market risk. I don't want to deal with what might happen on the open the morning on Wednesday before that expiration. Okay, so fairly straightforward. I couldn't share the numbers because we are going to be in the paper trade portfolio. But if you have any questions and you are in the YouTube channel for Tradier, you can ask any questions, put them in the chat box. Happy to address them. If you are on the hub, the Tradier hub, where you get access to all the speakers and you have a sign on, you can also ask questions through the Tradier hub. Lastly, if you're on X, well, welcome, because we are streaming to my X, which my handle is very simple. It's at my name, at Brian Overby. That's my X handle and account. So if you would like to stream it live in X, feel free to do that. And that's where I actually will tweet out some updates. And I'm going to get a little better at that during the week as to what goes on with some of the paper trades that we put on, or they're not always paper trades, but we like to call them that. All right. So now let's go, and we're going to actually go to the Tradier Pro software. And here is the portfolio of deep in the money option contracts. And you'll notice that some have different expirations, and we'll just focus on days to expiration inside the portfolio, inside the Tradier Pro. And we see that Amazon's got 205 days, so does Google. IWM, we've already rolled. That's got 300 and well, actually, we put it on as a new position, 359 days. That's the only one that's really kind of hurting us. As far as Caterpillar is concerned, we've already taken profits on Caterpillar. We only got one option contract, and that's down a minimal amount relative in that position. But we came back in and took on a new position there. Not too concerned about that one. Over here on the IWM position, the market, I expect a lot more volatility in IWM. As a matter of fact, we still got a long straddle that we should have closed out today. The expiration is coming up soon. I think it's this Friday. So we should have closed out that long straddle, but I digress. Lilly, we've done very well. If you look at the chart of Lilly, it's basically been parabolic, much like NVIDIA. And that position we've already rolled and already taken a big chunk of money off the table. And lastly, we have Charles Schwab. So Charles Schwab is 205 days. We need to roll that one, and we need to roll the Google position. Home Depot, I'm just going to let ride. We base a lot of the rolling on the delta, and I switched up my deltas here. I normally have a position delta, but this is actually just for the individual option. And this is a nice feature of the portfolio and the Tradier Pro is that you can say Greek display and you can do cumulative, which means this is the position Greek on 4 option contracts. If the delta was 1, it would be 400 because you take 4 times 100, and that would give you the position delta. I right now trying to figure out which ones I want to roll. If the delta is getting to 1, well, then I want to roll that position. So the delta is 1 here, down here on the Schwab position, the delta is 1. And so on these positions, I'm actually going to roll it, take some money off the table, and put on a little bit less risk. So I'm going to start with the Google position because I already have that one loaded up. So this would be my adjustment to the trade. We've doubled on the Google position. If you notice here, we're up 104% on that trade. We put it on for $40. It's now trading for $82. Now, also realize, though, that inside this portfolio, we didn't have all the risk to buy 400 shares of Google. And that's the concept. We're not going to take all of we're going to always have a large cash position. And if you look here, we're seeing that the cash position right now in this portfolio is $123,000. We're using options to minimize risk. We're still giving ourselves some upside. So the fact that we doubled here isn't necessarily a double if you consider that we don't have all the cash in the account. We don't have it all allocated. And that's the plan. That's why we're buying deep in the money options as an alternative to buying stocks outright, because that cash is our security blanket. I guess the moral to my story is that you need to look at it as how much are we up on the entire the position if we had bought 400 shares, right? That's the way that I would look at and we wouldn't have doubled on that trade. But it's awesome that it did. It's awesome that it did. And we were able to get that type of upside without all the risk on the downside. And that is why we like to buy leap options or longer term options as an alternative to buying the stock outright. The battle is always the width between the bid-ask spreads. So let's go and look at an options grid and let's take this to the next level. We're going to take some of the profit off the table and we're going to roll to our original position, which was an 80 delta. So an 80 delta option, that's what we started with. So I'm going to go to the options grid, and the option contract that we bought or that we're currently in kind of makes sense. We're in the 2025s. A lot of times when you're targeting options And especially if you're in a taxable account, you'll go to that January option contract of the next year, just putting off any taxes that you may have until the next year. It gives you that option. Doesn't necessarily mean that you're going to do that and let it go all the way to that expiration, but it's nice to have that option. So you'll see a lot of volume in the January of the next year option contracts. We are now down to 205 days remaining, so we're going to go out in time. We're still bullish on Google. And our option contract that we own right now is the 105 strike, and we see the delta is at 97. So that's our position. We're going to roll. We're going to go to, if we look at the portfolio, we're going to keep with the same days to expiration that we have in Lilly, that we have in IWM, which is the Russell 2000 index. And in order to do that, that is the June 20th expiration. I'm going to click on this and it will show it over here. And we're going to go all the way up to the 80 delta, somewhere around 80. So this has always been my issue with deep in the money option contracts, and I'm going to highlight this. But in this scenario, we're going to roll to the 160s. The market's at 185. The option contract is still a real contract. We're talking about a $39 option. The ask is $39.50 and the bid is $38.60, almost a dollar wide. And you look at the stock, you're a penny wide, 183 by not even a penny. That's a very, very, very tight market on the bid and ask on the stock. But on this option contract, it's over a dollar. So by rolling, you can usually get midpoint fills, but I pay a lot of attention to open interest. So most of the open interest here is in the 170 strike, and I'd like to be in that strike. And if you notice, the market is it's not that much tighter, I guess. But if I look at this, I'd rather have more open interest than less. So we have the 81 delta right here with 1,300 as the open interest. And we have the 87 delta right here as basically 7,000 for open interest. So I'm going to lean to this one because I want to have more people interested in my option contract and more people making a market. As a matter of fact, we see the market actually got a little tighter here. It's 39.60 by 39.20. So this is the one that we're going to roll to. We're going to roll out. We're going to come from this option contract down here, which is an $82 option contract. We're going to basically take half of the profits off the table. We're going to put that in our cash reserves. We're going to reduce our risk by that amount, but we're still going to have an option contract and we're still going to have to manage those contracts. And we're going to roll out to the June 20 and add, what is that, about 100 and we'll call it 150 days onto our position going out into that June contract from the January expiration. So let's do it. Let's enter the trade. So we look down here, already have it set up. We're selling to close the January 17, 2025 option, and at the same time buying to open the 160 strike 620 2025 option. We're going to do this for a net credit. Now, this is in a paper trading portfolio, so I want to limit that net credit in that position. So we're going to come in and, well, I'm saying midpoint fills are tougher to get. I don't know where I was going with that. Midpoint fills are harder to get, but I would try to work this. I would do 43.10 maybe, or 40 on the other side, go maybe 43, give up 7 cents because we're doing this for a net credit to the account. But let's see, if we do the ask here, we're talking about a 42. Let's try 42.50, see if that will fill. And net credit, good for the day, send it to the floor. Do you want to do the long diagonal? That is true. We're just basically rolling a position though. But that is considered a long diagonal because you're selling an option contract with this expiration and buying one with that expiration. And we've sent that to the floor. Okay, so over here in our alerts, it's telling us we're selling to close, buying to open, net credit, and it has not been filled yet. Now, have any questions on that position, feel free to put them in the chat box, and I will try to address them. We got one last one that we need to do. We're going to go into our portfolio. We're going to look at the Charles Schwab position. We see that the delta is 1 in this scenario. And this position, we bought it for 20 and it's now selling for 30. We're up 49% on that trade, and we're going to roll this up and out in time also. So we'll go here and let's go in this scenario. We're gonna yeah, send to options grid. We got Charles Schwab. We have the 105 calls. Let's get rid of the Google position. We are looking at the 45 strike for that expiration. And we will go out to that same June expiration. So we're looking at the 45 strike here. And oh, there we go. We just filled. All right. Good. Oh, we filled two out of the four. Interesting. Huh. All right. I didn't know you could get a partial fill in a paper trading app, but okay. Oh, did we not? We did not. We did not send the whole amount. All right. So let's go back and redo this trade because we just did one of them. We wanted to do all three of them. Let's take this and let's go into the what if calculator. Got it here. And we're going to send this just to the trading floor. Send to ticket. And we got to do a 3x3. All right. 42.50. We'll keep it there. That should fill. All right. Net credit 3x3. Send. All right. Back to the Schwab position. Options grid. Charles Schwab. Portfolio. We have three contracts. 117.25, 45 strike. So 117.25, 45 strike. We have three contracts. We are going to sell to close. 1, 2, 3. And then we are going to go to the January expiration. 359 strike. We're going to find the 80 delta that we want to trade. So 82.76, 78.22. There's 428 open interest here and only 45 here. Yeah, we'll do this one. So we're looking at $5.97 of extrinsic value. So still a lot of time value in it. And we will be buying this one. And we're going to buy three of those. So here is our position. We're selling to close the January 2025 117 expiration 45 strike call. Then at the same time, we're going to buy to open three of the June 2025 June 20th expiration 65 strike call. We're going to do this for a net credit of well, let's see if we can get 15. Let's put 15 in here and we'll send it and then maybe adjust that trade. So we hit send. Answer is yes. And we'll go back and look at our orders. Okay, so we filled all of our Google trades. We're out on all of them. So if we go back to our portfolio, we should see 4 of the new Google position. And it's going to recalculate our profit and loss and everything to go with that to start with. And here we're seeing 359 days. Quantity is 4. Now, if we go back to our orders, we see that the Schwab trade is still sitting here and it's open. We can adjust this trade. So let's take this and adjust it. And we'll try to get this filled before the end of the day. We'll go closer to the bid here. Let's go 65. We need to take this. And we'll send this to the floor for 14. Let's go 1460. Let's make sure it fills. All right. So that's it for this edition of Options Guide TV. If you have any questions, I'll make sure that that trade gets filled inside the portfolio, and we will see a different expiration date when that fills. And we still got a couple other positions that we need to look at. Home Depot, I think we're going to let that one ride for a little bit. That position actually we've already done okay on Home Depot. We sold and adjusted this position once. On Amazon, we got 4 of these, and we are currently at up about 19% on this. We bought it for 41. It's now selling for 49. We'll let that one ride. The Delta's still at 87. The Home Depot, we might actually buy another one. It actually kind of makes sense. Let's actually do that. How much time we got? We got about 2 minutes left before the end of the show. So let's add to this position. We bought this at 55. It's now at 52. Yeah, I still want to trade this. So send to options grid. And the Home Depot is the 300 strike. And let's buy one more of those before the show is over. Uh, 52, let's go 52.60. Pay the ask. And normally you would be working these a little bit more, but in a paper trading portfolio, they're not dealing with real markets. So we are not going to really work the order. We'll put it in fairly close and hope that we get an okay fill on it. But in this instance, we're going to buy to open. We're going to add to this position one of the January 17, 2025, 300 strike call options. And this too. Let's just hit it. And we're going to hit the ask. Here we go. Order has been sent. Go back to the portfolio. And now we see that our cost basis is 54 and the market is currently at 52. So we cut that in half and we'll let that position ride. All right. Now this is really it for this edition of Options Guide TV. Thanks for hanging with me. We did just fill on that trade, and we will see you this coming up Friday for the next edition of Options Guide TV. We will look at another trade. We'll look at our weekly trade since we mainly just adjusted the portfolio this week, and we're going to be coming into earnings season. So earnings are going to start to kick off here not fairly soon. And that's it. Thanks for stopping.
Thanks for watching. Please be sure to take some time to read the disclaimer. Thank you.